Have you taken a few deep breaths after exam number 2 and the dividend discount models and the price ratio models and all the introduction to stocks data that you had to learn? And well, guess what? We've reached the pinnacle, dear students. We're now on the other side of the mountain and we're beginning to descend. And one of the things that we do in this class is we ask you the same questions that we asked you in exam number 2 in exam number 3. Very similar. Many of the questions will be very similar. We'll ask you some calculations from chapter 6. Of course, I will delineate and define exactly which ones. Dividend discount models, discounted cash flow models, yes. Because this information is so important, we want you to go over it enough times so that you're looking at it in your sleep. You're dreaming about it. You see it as you do your chores during the day. You see the discounted cash flow model. And what we're going to continue with is chapter 17, which is projecting cash flow and earnings. Well, really, folks, I'm going to concentrate on the ratio analysis. In the 3rd edition, if anybody still has it, if anybody picked that up on the internet, it's actually chapter 7. And it deals mainly with financial statements and ratio analysis, which isn't important enough to warrant our attention. Not as powerful as the dividend discount models, but Mr. Benjamin Graham, in his book The Intelligent Investor, and then later on in Security Analysis, is a big fan of ratio analysis, and I'm not going to argue with him. They also discuss the forecasting. We've done a little bit of forecasting, and if you want to play with the forecasting for the financial statements, you go right ahead. But mostly what we're going to do is deal with financial statements and ratio analysis. So let's get started on slide number 2. If you've taken accounting, you know what a balance sheet is, you know what an income statement, and you have a decent idea of what a cash flow statement or a statement of cash flows. Now, if you took the BUS123 class, you created a balance sheet, we called it a net worth statement, and a cash flow statement. Well, it's not the same thing. It's the cash flow statement in the 121 class is really an income statement. But the accountants just cringe when they look at how we create it and what we call them. So you accounting students, you'll have a bit of an advantage over the rest of us when it comes to discussing these statements. The balance sheet, the income statement, and the cash flow statement are all crucial documents that every 3 months and then yearly the corporation must produce. Publicly traded corporations, part of the deal is that they have to divulge all their information about themselves. And it used to be that some of them would just basically play fast and loose with the numbers, and some of that still goes on. But now, if they do that, they can go to jail. Before they could just say, "Oops, we're sorry." Now you can't do that anymore. Enron was a big example of that. They were basically just cooking the books, and it's nothing new, folks. It's been going on for hundreds of years, but now with all the computers and all the people who are knowledgeable about accounting, there's no excuse for other than outright fraud. And so let's take a look at each one in detail. The balance sheet, what we called in the 121 class, Financial Planning and Money Management, our net worth statement. The formula is basically the same, and the usage of the balance sheet is basically the same. It shows us our assets, what we own, and our liabilities, our debts, what we owe, but on a corporate scale. And we subtract the assets minus the liabilities, and we get the equity, shareholders' equity. In personal finance, we call it net worth. We do not have to do any of these journal entries and trial balances, folks. It's all done for us. So if your accounting students are starting to sweat and have panic attacks, relax. We're not doing that in this class. I did it a long time ago, and I vowed I'd never do it again unless somebody offered me a lot of money. But hey, that's why we have accountants, and those of you who are, as I said, are taking accounting will have a bit of an advantage over the rest of us peons. The accounting world tends to lump the assets and liabilities into current, meaning anything up to a year, and long term, anything over a year. Well, that's not how we finance and investment folks do it. We tend to look at short term. We don't call it current. Short term, 1 or 2 years. Intermediate term, 2 to 5 years, and anything above 5 years is long term. But that's not how accountants do it. They look at anything consumed within the next year as current assets, current liabilities, and then anything above that is long term. In the face-to-face class now, what we would do is we would pass out a sample balance sheet, and a cash flow statement of cash flows, and an income statement. And so on the website are three of the three financial statements for Ford. And we'll come back to that and do some calculations in our second presentation. So you're going to want to print those out or have them on your screen in our next presentation. Or you can look at them now. It's up to you. Slide number 4, the income statement. The income statement is what we call the cash flow statement in the financial planning class, and every one of the accountants, as I said, cringe and don't like that we do that. Shows us our income, our revenue, and then our expenses. So the difference between the company's revenues and expenses is called net income. Now, the corporation may, if they want to, distribute that net income in the form of dividends to their shareholders. They do not have to. If they don't, then you accountants, do you remember what that's called? Right, retained earnings. Indeed. But as we've discussed in the past, sometimes the income and the expenses are not always received or paid in cash. Yeah, so if you're a corporation or an individual, you're going to try to show the IRS as few dollars of income as possible so you can pay fewer dollars in taxes. And there are certain rules, and we discussed the one, depreciation. Very important, right? Depreciation, which is not a cash expense. We don't write a check to depreciation, but it still allows us to lower our income so that we pay fewer dollars in taxes. Well, we would take a look at an income statement now for Ford. You can download it, take a look at it later or now. And because the income and the expenses are not always received or paid in cash, the accountants have created what is called the cash flow statement. Right? Not the same thing we did in 121, if those of you have taken 121. Sometimes called the statement of cash flows. Slide number 5. The statement of cash flows, the cash flow statement, shows us what has happened to the company's checkbook. Exactly. What money has come in, what money has gone out as a result of not only the business, but also the business revenues and the business expenses, but also some other non-business related, I should say, relating to the individual business. I'm confusing you. I apologize. Of course, it's all related to the business. But there are certain things such as cash flows resulting from investments and cash flows resulting from financing. Exactly. So the statement of cash flows not only deals with those income and expense items like depreciation, but also deals with other other transactions that have nothing to do with what's going on with our business, what the products we're making and selling, and the income that we get. It more has to do with what's going on as just we try to finance our activities or buy and sell large capital expenditures, which we can't expense in 1 year, and that's why there's such a thing as depreciation. So if I'm confusing you, I apologize. What you might want to do is take a look at the statement of cash flows now, and what you'll see is that it starts where the income statement ends. Exactly. Take a look at Ford's income statement, or any company that you're interested in, and look at the bottom line, as it's called, the bottom line, the net income, and then run on over to the cash flow statement, and you'll see that the cash flow statement starts there and then adds back in depreciation and takes out any large expenditures and adds back any financing that the company might have procured. And the idea is, how much did your checkbook balance go up, or how much did it go down? And that's the cash flow statement. And as we discussed, we looked at price to earnings, and we also looked at price to cash flow. So indeed, you want to take a look at the cash flow statement to find out the cash flow of the company. Okay, so what does the company have to do? Every year and then every quarter, they have to disclose these earnings, these financial statements, their revenue, their expenses, their earnings, their cash flows, and they must do this in a fair manner. They must not give people on Wall Street or insiders information before everybody else gets it. So how they've this was almost 20 years ago when the Securities and Exchange Commission made this announcement, made this requirement. And so what the companies have done is they've created what are called earnings calls. They've scheduled a set date and time when these financial statements are going to be sent to the world via the internet. They're injected into the Edgar system, and so then it becomes available for everybody. And at the same time, there's an earnings call where you can log in via the internet, or just call. There's an 800 number you can usually call, and that's what I asked you to do in Chapter 5. And some of these are quite interesting, and others are really boring. A lot of it depends on how much good news and how much bad news the company has to report. So I hope you enjoyed their earnings calls. I like to listen to the first 15, 20, 30 minutes. But then when the questions start coming in, the people start asking really stupid questions. Like, if there's a meteorite on Tuesday and followed by a flood and Ebola breaks out, and at the same time the continents drift, what's going to happen to your earnings? Jeez. Oosh. So sometimes you can hear the CEO and the CFO, the chief financial officer, basically just chuckle to themselves and say, "Well, what do you think, goofball?" So do enjoy these, and of course there are countless other sources of they call them whisper numbers. This is what we think they're really going to make. They say they're going to make this much, and they may be right, but we think they're really going to come up short or go ahead. And I've heard people opine that nowadays there is simply too much information. It's like, as we saw in chapters 5 and 6, a sip from the fire hose. You open up Value Line and you go, what is all this stuff? And there's a writer in the financial world. He probably won't read his books, but he's quite entertaining. And he has a saying called wisdom sold separately. Plenty of data. How do you make any use of it? Well, it takes time. It takes practice and takes making mistakes. Slide number 7. We're going to come back to something that we've already taken a quick look at, and we'll look at it in more detail, and that is financial ratios and financial ratio analysis. The financial ratios are the relations between two financial quantities expressed as the quotient of one divided by the other. And of course, the ratio analysis is the study of the relationships and the study of these ratios. And if you remember, back in Chapter 5 and then in Chapter 6, we started looking at the price to earnings ratio. Then we looked at price to cash flow. So we're going to quickly review some of these ratios. And what we want to impress upon you is that there is no one ratio that can accurately sum up the overall general state of a company. Each ratio must be considered in the context of all the information gathered. Plus, you must also consider any ratio in the context of the industry the company exists within. In other words, you got to look at their competitors, okay? You can't just jump on one number, one ratio. And you'll hear people do that. Look at that PE. Well, tell me about everything else. PE, price to earnings ratio, is very important, but it's only one number. And so what you get is this soup or this stew. I don't know if that's a good analogy, but you look at them and you just let all of them swirl around as you do the analysis, not keying on any one number unless it is highly unusual and leads us to think, we need to do more investigation. We need to do more digging into this company's story. Slide number 8. The first ones, and we've already taken a look at these, are the common stock ratios, also called the market ratios. They convert key information about a firm into a per share basis. And you remember the price to earnings ratio, the dividend yield, the dividend payout ratio, price to book, price to cash flow, price to share. So this is review. So we're going to spend a little bit of time, meditation, if you will, on PE, price to earnings ratio, because that's the one that people key on the most. And then we'll review the rest fairly quickly, because they're basically the same. It's the same idea, but just different numbers, different statistics that we're looking at. So let's take a look at PE, price to earnings ratio, folks. This is the most popular stock market statistic, and we remember that historically PE ratios were 5 to 12, 14 to 20 for growing companies. And it was just unusual, although it happened, that we had PEs greater than 20. But now it's commonplace to have PEs greater than 20. I mean, not all companies do. Lots of them have the average of about 14, 15, some less, some more. But that is commonplace to see more than 20. And as we said, the PE ratio tells you how long it will take in years, assuming that the earnings don't change, which they're doing all the time, for the company to earn back its price. And not that that's an important number, but it's something to think about. A PE of 3 means in 3 years the company's going to earn back their price. Now, do they have to turn that around and give it to the shareholders in dividends? No, they don't have to. A PE of 20 will take 20 years. A PE of 50 will take 50 years. So you get, yeah, exactly. Not that is that important, folks. Sometimes people say, well, does that mean I'm going to get my money back? No. I mean, maybe they might pay it back in dividends. They probably won't. But just think of that as a way to say, okay, well, PE at 10, 10 years, they'll have earned back everything I've paid into them. Now, I might get some of that back in dividends. Slide number 10. Let's take a look at 6 companies that you maybe have heard of. Exxon, certainly heard of them. Facebook, and Amgen is a biotech company. JP Morgan Chase, it's a bank. It's a bank, all right. General Mills, right? Cheerios, and Merck, a drug company. And we look at those PEs and say, "Wow, look at that! It's all over the map. How can we make any kind of analysis out of them?" Well, what we need to do is complete the picture. We need to take a look at their competitors. And you say, Exxon, wow, 35, that's really high. And look at all their competitors. Yeah, well, Exxon's the only one that's still making money. Everybody else has been clobbered. Well, Exxon's been clobbered too by the price of oil plummeting over the last couple of years. And so why is ExxonMobil's PE so high? Is that because investors believe their future is that bright? No. What's happened is the earnings have fallen. Price over earnings, right? And if you make the denominator smaller, that's how a ratio works. Usually we're used to making the numerator bigger to make the quotient bigger. But if you make the denominator smaller, then that quotient, that ratio expands. And that's what happened here. Exxon, but not only Exxon, they're hurting from earnings. And their competitors are all losing money. So they don't even have a P. Well, it's a negative number. It's not usually shown. You can look at it. You can compute it and get a negative number. Their earnings divided by their negative earnings. I mean, their price divided by their negative earnings. But what this is saying to us is that investors as a whole are just, they're just, energy companies are just destroyed. Because the price fell from $100 a barrel, $110 a barrel, and $90 a barrel, down to 30, 40. It's back up to around 50 or so. But still, now's a good time to look at energy stocks. Exactly. Right. What about these guys? Who are these? Amgen, Biogen, Celgene, Illumina. Well, they are biotech companies. And as you would expect, 17, Biogen, 18... respectable PEs, not too high, not too... Wow, look at Celgene, 44. Look at Illumina, 63 and a half. And what does that mean, folks? Does that mean we should automatically say we'll never buy that company? The PE is too high. Or does that say, oh, let's buy that company. The PE is really high. Everybody thinks it's going to do really well in the future. No, what it does is it's like a little red flag. I used an exclamation point here, but you could think of it as a little red flag saying, ooh, look at me, look at me, look at me. Something's going on here. And we need to do more investigation. Maybe Celgene, maybe Illumina are growing so fast, or the potential is so great that they deserve a PE that high. Because just because a PE is high doesn't mean it's not a good value. And just because a PE alone is very low doesn't mean it's a great value. You got to look at the company as a whole. And then the same thing is true for these food companies. General Mills, Hormel, a little high, but Kellogg's and Kraft, what's going on there? I don't know. I don't really follow these companies too much because I don't eat their food, but you might say, I think things are going well for Kraft, which just merged with Heinz, and Kellogg's, which is trying to defend selling sugar to children in massive quantities and yet getting away with it. And it's cheap, folks. Sugar's cheap, so they sell it and they make a lot of money. You might even look at the history of the Kellogg's company. It was two brothers, and the one brother didn't want to introduce sugar into the products, and the other brother did, and the other brother won. It's interesting history of this 100-and-some-odd-year-old company. Now let's swing on over to Merck, Pfizer, Eli, and Bristol Myers, some drug companies. And we see those PEs are fairly high. Yeah, but who knows? Maybe they're well-deserved, or maybe it's just an example, yet another example of what people are saying. Stock prices are too high! October 2016, we are due for a correction. Well, I agree with that, folks. We're long overdue for a market downturn, a correction, a bear market, a crash, whatever you want to call it. Prices are high for many stocks, but prices are not that high for all stocks. Look at the banks. J.P. Morgan, Wells Fargo, U.S. Bank, Citigroup, all in the low teens. I loved a presentation I saw a year ago, from a bank analyst who was talking about how banks are, he felt that banks had capitalized, which is a fancy way of saying they got enough money to survive well, and that he was very happy with the banks these days. And so I asked him, so can we tell people that banks are boring again? He said, oh, gee, I sure hope so. Because the banks for decades were really boring. They made lots of money. How do you know a bank is making money? Their doors are open. And they were boring. And then in the late 90s and then into the 2000s, banks started getting exciting. Well, that was a bad sign. A really bad sign. And sure enough, and that's what caused one of the things contributing to the 2008, 2007, 2008, 2009 financial crisis. And now banks are boring again with low PEs and healthy dividends. And so I saved this last one because obviously these are the hot commodity stocks now. Facebook, 62.5. But look at Amazon and Netflix, 200, 300 PE. Yes, dear students, this, if these companies don't continue to shoot the lights out and explode as they are with their earnings on the upside, the parachutes had better be very, very large, because look out below. Indeed. And look at lowly little Google now. 25. Big deal. Big deal. Twitter. Yeah, I don't know what's going to happen with Twitter, folks. They can't make any money. Even though everybody uses it, they can't monetize it. So somebody's going to buy them, but nobody wants to pay what they're worth, which I think is about 10 billion now. I don't know, but they're not worth that. Obviously, they're never going to make any money. How can a company that's never going to make any money be worth 10 billion? I don't know. I'm not in that world, so I don't know. Apple. Good old Apple. Check out Apple. 13. Right? I know. It's amazing. I don't know why people just don't think Apple. I guess they think their glory days are over, and yet everybody still wants to buy their products. So whenever people say that the stock market is overvalued, you could say, yeah, some companies definitely. We can take a look at some of these PEs and say, yeah, some of these companies are very richly priced. But then others, not so bad. And if we go back and do the techniques that we learned back in Chapter 6, apply the ratio analysis that we're learning in this chapter, we're going to coax out some companies that are decently priced and tilt the odds in our favor. I think so. Slide number 11. How can we account for the wide PE disparity between different industries and different companies within industries? Again, we go back to the expectation of the future. The expectation of future earnings, future dividends, dividend growth from investors. Remember that the companies that have grown their dividends over decades are often the best companies over the long term. Right, exactly. Now, this is a wonderful quote attributed to Jack Dreyfus, who started the Dreyfus Funds, one of the nation's largest mutual fund companies. And it's from the Random Walk Down Wall Street. So you probably can't see it if you're looking at this on your cell phone or tablet. But let me read it for you because I just love it. He's a funny guy. Take a nice little company that has been making shoelaces for 40 years and sells at a respectable 6 times earnings ratio. Change the name from Shoelaces Incorporated to Electronics and Silicon Firth Burners. In today's market, this is the 1960s, the words electronics and silicon are worth 15 times earnings. However, the real play comes from the word Firth burner, which no one understands. A word that no one understands entitles you to double your score. Therefore, we have 6 times earnings for the shoelace business, 15 times earnings for the electronics and silicon, or a total of 21 times earnings. Multiply this by 2 for Firth burners. And now we have the score of 42 times earnings for the new company. Yeah, right, exactly. Replace first burners with nanotechnology or 3D printing. Replace electronics and silicon with social networking and China. And you have today's world. In fact, a few years ago, a company called Nanotech, which is based here in San Diego, started to see their stock price rise. And they didn't know why. And people were asking, what's going on? We don't know. Nothing's new. And what people attributed it to, although you can't go around and interview every investor who bought and sold, right, is that the fact that nanotechnology was starting to make it into the mainstream media. And some of the applications that are currently being used for nanotechnology were highlighted. And so people ran around looking for companies that had something to do with this. And that, wow, look, this one's called Nanotech. I want to buy this one. Yeah. Well, exactly. As Mr. Graham has reminded us, it's often the fault of the public. Slide number 12. Priced earnings to growth ratio. This one you don't hear too much about. And which is sad because it's kind of important in that it compares the PE ratio to its rate of growth. It used to be that the company's growth ratio was what warranted a higher PE ratio. And it's still true to some extent, but what investors were looking for was a PE ratio that was similar to the growth ratio. So if the PE ratio were 20, the company was growing at 20%. If the PE ratio were 10, the company was growing at 10%. You got it? And so when you do that, when you divide any number by itself, you get 1. So if the PE ratio is 1, that means the PE ratio is matching the growth rate of the company. And anything 1 was desirable. Well, now it's easy to find companies with PEG ratios that are much higher than 1. It might be growing at 20% and the PE is 60. Right, so keep that in mind when you're looking at the potential volatility risk of loss when you buy a hot stock. Slide number 13, dividends per share. Now, we've discussed this one. We've looked it up. We don't have to calculate it. It's a measure of how much dividends each share of a stock will receive. And as we've discussed, dividends are important again. Dividends can be discussed in polite company. Yes, they can. We love dividends, right? Don't we? I love dividends. I don't know about you. I love them. I love them. Slide 14. Dividend yield. Measure of how much dividends are as a percentage of the stock price. Again, a very important statistic that allows us to compare our company to a bond or a savings account. Remembering that the stock dividend is not guaranteed. It is totally optional, and they could stop it next quarter. They could just say, nope, sorry, we're not going to pay a dividend, or they can lower it. And traditionally, 4, 5, 6% was considered good. S&P is yielding over 2%. 10-year bonds are yielding, no, they're yielding actually a little less. I have to change that. They're yielding a little less than 2%. And savings accounts are yielding far less than 1%. So some stocks are paying much more, right, than 2%. Others are not paying anything. And many growth stocks that used to be growth stocks are now paying healthy dividends, like Apple, like Microsoft. Indeed. So check them out too. Slide number 16, the dividend payout ratio. Again, we've already gone through this. This is a measure of how much of a company's earnings are being paid out to the shareholders in the form of dividends. And as we've seen, more mature companies often pay out much of their dividends. Why? Because they don't need the money. They don't need the retained earnings to plow back into the company. And companies that are growing fast need that cash, so they don't pay high dividends. Slide number 16, the book value per share. That's the common stockholders' equity divided by the number of shares outstanding. We look it up. We don't bother doing the calculation. And if you remember, if this is basically telling us that if we liquidated all the assets, paid off all the debts, this is how much money we would have in our hands. Knowing full well that doesn't work that way. If you tried to liquidate a company, you probably would not get what the value that is on the books of the asset. Plus, the company is worth more intact than if it were dissolved. And that's why the book value per share is often far less than the market price. This is review. I hope you remember this. Slide number 17. Price to book value. Remember this? This is just relating the market price to the book value. And again, 3 or 4, meaning the stock price is 3 times higher or 4 times higher than the book value, is not uncommon. In fact, it's very common. And it used to be that companies were very worried, investors were very worried about this price to book value, because what if the company had to replace the assets on its books? And this is when people were thinking in terms of huge factories and the like, but now you got companies that have hardly any assets, except for a bunch of computers running somewhere in some location. And so how much does it cost to replace those? Not very much at all. So it doesn't always work that way, folks. There's this one statistic that people throw around called Tobin's Q, or some strange name. But it's how much it would cost for companies to replace all the assets on their books. And supposedly, when that amount gets higher, it's a different world than it was 100 years ago, certainly. But it's something to think about. You don't want to price the book value that's way skyrocketing unless you invest in Amazon or Netflix. Slide number 18. Price to cash flow. Same idea. And this is review. We discussed this already. We take the current price divided by the current cash flow per share. Instead of price divided by earnings, it's price divided by cash flow. And as we said, cash flow often differs from earnings per share for several reasons, but the most common reason is the depreciation. And so you will look at the statement of cash flows, the cash flow statement, to add back in that depreciation. And we discussed the good quality earnings versus poor quality earnings. The example we used was Lucent Technologies, that was booking record earnings and their cash flow was going down. Their checkbook was going down. How could that be? Well, they really weren't getting the money. They were just getting IOUs from companies that weren't making any money and probably would never make any money for several years, promising to pay back the money that they borrowed by buying their equipment. And Lucent almost went bankrupt because of that. Yeah. How can you report record earnings and your cash flow be negative? Simple. You don't get the earnings for 20 years and then you wind up never getting the earnings. Slide number 19. Same idea. Price to sales ratio. This is review. Instead of looking at price to earnings, price to cash flow, we look at price to sales. And during the internet mania, many analysts were using price to sales instead of price to earnings, since most all the new companies never generated any earnings. Okay, so I hope this quick review of the last few slides was not too quick. Go back and look at it again if you need to review, but we've already discussed these. And these you're just going to look up. In our next presentation, our second presentation for this chapter, we will learn how to do some calculations that you don't look up. Some of them you do, others you need to calculate yourself. And so it'll be a little bit more meaty, a little bit more substantial. Before you do the next presentation, make sure you have printed out or have at your disposal the Ford income statement and the Ford balance sheet. And if you want to do some price to cash flow stuff, get out the statement of cash flows, but we're not going to do those in our presentation. So these are the common stock market ratios. You can look all of them up. You've already looked up almost all of them. And in our next presentation, we'll learn how to calculate some And so we'll do some calculations. So have your calculator, have the statements, and we'll see you in our second presentation of Chapter 17.